Hi guys, this is Victor with Alarm CPA. Welcome back. So taxes, guys, are more or less a cost of doing business. It's a cost of you making money. It's a cost of your investment. It could also be a drag. So it could be a drag on your investment returns. Dividends are taxable, interest income is taxable, capital gains are taxable. So your after-tax investments return, what you keep, what is important. Not what you make, but what you keep after taxes. So what you keep after your taxes and after your fees of investments is what's important. And with tax rates probably going higher and higher every year, you want to do the right planning, right? You want to make sure that you're not overpaying taxes, right? That's the whole strategy here. You want to make sure that you're complying with the law, with the rules and the regulations. But you want to plan, right? You want to do things the right way. Then if you think about it, let's say you own a business or you have a job. So you have the income from your job, the income from your business, and also you have the income from investments. And then if you aggregate all this income, then your tax rates could be at a higher tax rate, right? And you don't want that. So if you combine your income from your job, the income from your business, and your income from your investments, automatically you're gonna be going to a higher tax bracket, and you wanna do the right planning around it. And if that happens, it could trigger a higher tax rate and you could have additional investment tax. Here we have 6 different ways that will help you maximize your after-tax investment income. So let's dive into it. Number 1, you want to use low turnover mutual funds. Mutual funds report a turnover ratio, and this is the rate in which fund managers buy and sell stocks within the portfolio. So the higher the turnover, the greater the likelihood that the taxable gains distributions at the end of the calendar year. So in other words, remember guys that we've talked about mutual funds before, right? And the turnover ratio means the investments that are inside the mutual fund, okay? And the turnover is the amount of times the investments are bought and sold within the mutual fund. So the higher the turnover, meaning the higher the rate in which these investments are bought and sold within the fund, likely the higher the capital gains that you will have from the mutual fund. So you want to make sure that the turnover ratio in the mutual fund that you buy does not have a high turnover ratio. Number 2, guys, so you want to use index accounts in taxable accounts. Okay, let's talk about it. Index funds, guys, such as Vanguard index funds, you can see the description below, have a low turnover. So that automatically, by having a low turnover, means that the rate in which the broker buys and sells investments inside the fund is very low. So automatically, it's gonna have probably less capital gain activity. So there is very little buying and selling, and typically lower capital gains distributions in index funds than active funds. For that reason, guys, index funds can be a good investment in your brokerage account. Point number 3, guys, active indexing helps even more. Think about it. Active indexing is owning each individual stock in a stock index instead of buying the index mutual fund. So instead of buying the fund itself, which has multiple stocks, which has multiple investments or multiple stocks or shares of companies, you actually actively index your own investments. So you own the stock instead of buying or owning the fund. That way, there's much less turnover than, if you think about it, if you are like Warren Buffett or if you are like Bill Ackman.
We like businesses that we call them simple, predictable, free cash flow generative, dominant companies, businesses with a moat around them. And the way we make these decisions is we do our analysis.
Or if you are like Carl Icahn, which these guys invest for the long term, for the long haul. So instead of buying a fund, you actually go into the index and you find in the index which is the stock of the company you want to own, and you actively index it yourself. So you hold the stock for the long term, thus there's less capital gain activity in the short term. Of course, you'll exit at some point, but you can push that to the future. And you do this to increase the opportunity to harvest losses in your portfolio. If you see our prior videos, guys, we're talking about loss harvesting and how that could be a good strategy for tax purposes. So click on the link below for you to make sure that you don't miss the explanation that we had not too long ago about tax loss harvesting. Okay guys, thank you so much for watching this video, and as always, click like and subscribe. Leave us a comment down here below and look at the description for additional information. And as always, I'll see you in the next video.